Treasury yields fell nearly every day this past week. By Thursday, the 10-year T-note had fallen nearly 25 basis points. Did you miss the peak? Hello, members, super savers, and bond course fans. I hope you're having a good week. A nearly 25 basis point drop is a lot in bond land. But before we dive into that, I wanted to share this chart with you because I think it's an important one. What do you think this chart shows? Drop a comment below and let everyone know your best guess before I reveal the answer. What this chart shows is that bond prices and yields on the secondary market are not always stable day to day. This yellow line shows the yield on the 3-year T-note for the past month only. Looks like a bit of a roller coaster, and it's not just the 3-year T-note. The trend is similar for both the 10-year T-note, this red line here, and the 30-year T-bond, this blue line here. Bond prices can in fact be very volatile. Remember, this is just a 1-month snapshot. Bond course fans, please refer back to Module 1, Video B in Bond Masters for a more detailed refresher on bond price volatility on the secondary market and where the stability in bonds actually comes from. Because yes, bonds can be a stable investment if you follow a few basic rules and employ techniques such as bond laddering. For those of you who need a brush up on the relationship between bond prices, interest rates, and yields, these are the videos in Bond Beginners that will jog your memory. And if you're not in our bond courses, then join our mailing list on our website to grab our free Bond Bites video mini-series where I talk about bond price volatility and 4 other common fixed income misconceptions. I've included the link to our website in the video description below as well. But back to our chart. If you're wondering why I chose these 3 maturities, it's because treasuries with these maturities will be auctioned off in the upcoming week. But more on this towards the end of the video. So you see this steep and continuous drop here in bond yields? That happened in just a matter of days this past week. And at certain points throughout the week, it did look like bond yields had peaked. But like I said, bond prices and yields can go up and they can go down, just like stock prices. So with that in mind, these are the 3 topics that we'll be covering in today's update video. Why did bond yields drop so precipitously for most of this past week? Did bond yields end the week up or down overall? Plus, what's on the upcoming auction schedule and what are the yield expectations for some of these auctions? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Here's where yields ended the prior week on Friday, May 31st. And we'll look in particular at the range from the 2-year T-note to the 30-year T-bond here. And this is where yields were 4 trading days later on Thursday, June 6th. As I mentioned earlier, the 10-year T-note was down nearly 25 basis points. In fact, the decline in bond yields for the first 4 trading days of this past week was pretty ugly overall. Let's talk a bit now about why. On Monday, the Institute for Supply Management's index showed that U.S. factory activity declined more than expected last month. Industries such as machinery and chemical products attributed this decline primarily to higher borrowing costs and a slowdown in new orders. Some industries like furniture, however, reported the opposite, stating that business was actually picking up, but the market focused more on the sectors that didn't grow than those that did continue to do good business. Because this slowdown in manufacturing can be one of the indicators of a slowing economy, which in turn gives hope to financial markets that the Fed might cut rates sooner and faster rather than holding them higher for longer. And as if in sync, also on Monday, the Atlanta Fed revised their second quarter GDP estimates down significantly, and bond yields started to tumble on the very first trading day of the week already. So that was Monday. On Tuesday, the Bureau of Labor Statistics, the BLS, reported that U.S. job openings fell in April to the lowest level in more than 3 years. And again, a slowing labor market can also be an indicator of a slowing economy and would imply that the Fed might move towards cutting rates sooner rather than later. On Wednesday, ADP Research Institute indicated that private sector hiring in May grew at the slowest rate since the beginning of 2024, which supported the BLS data from the previous day of a possibly slowing labor market and economy. And to put the cherry on top, so to say, both the European Central Bank and the Bank of Canada cut interest rates this past week. No surprise then that bond yields fell so precipitously for most of the week. All these data points seem to indicate a slowing economy. And then came Friday's jobs report from the BLS showing that non-farm payroll increased by 272,000 in May, and the unemployment rate changed little at 4%. This 272,000 increase, it was about 50% more than what the market had predicted. And unlike these previous data points, this jobs report was not a sign of a slowing economy. Quite the contrary. So overall, we saw some mixed signals for the markets in one single week. And I'm sure you're wondering at this point, what happened to bond yields on Friday after the blowout jobs report? Which brings us to the next section of our update video today. Now, having already shown you the development over the first 4 trading days of last week, let's now complete the picture by looking at the entire week and compare Treasury yields from this past Friday versus the previous week to see how things ended up overall. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. In just a single day on Friday, the positive surprise from the jobs report pushed the medium and long-dated treasuries up 12 to 17 basis points, depending on the maturity. But that push was not enough to end the week in positive overall yield territory. Bond yields still ended the week mostly down, with the exception of the 3- and 4-month T-bills. Relative to the beginning of 2024, though, bond yields are nearly all still up, as you can see from this table comparing Treasury yields from this past Friday versus January 2nd. This row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black and decreases in rates are shown in red. The 1-month and 2-month T-bills are still down a few basis points, but otherwise, rates continue to be higher overall across all the other maturities, and noticeably higher on the medium and long end. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Resource Center website here. All sources are linked below in the first pinned comment. So, that was a recap of bond yields from last week. Now, let's take a look at the upcoming week's auctions. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. The 52-week T-bill will also be auctioned off on June 11th. And if we scroll down further, we can see the 3-year T-note, the 9-year and 11-month T-note, and the 29-year 11-month T-bond will be auctioned off as well this upcoming week. The 3-year T-note is not a reopening auction, so the coupon still remains to be determined on auction day. The 9-year 11-month T-note and the 29-year 11-month T-bond are reopening auctions, so we already know what the coupons will be on those. At the time of this taping, here's what the coupon and the expected yield are for the 3-year T-note auction on Fidelity's platform. And here's what the coupon and the expected yield are for the 9-year 11-month T-note auction. And here's what the coupon and the expected yield are for the 29-year 11-month T-bond auction. Do keep in mind that these numbers can and usually do change all the way up to the time of the auction. And in particular for the 29-year 11-month T-bond, because this auction will take place only after the BLS releases the next inflation report, the next CPI data, on Wednesday, June 12th. The same day as the FOMC's June rate announcement decision, although the current market consensus is that the Fed will leave rates unchanged. So I hope you enjoyed this video and learned something new. And if you did and want a deep dive into how to invest in bonds and build a bond portfolio while yields are still attractive, then check out this video here on one of our 2 recently launched bond courses. Or join us in one of our live sessions in June. Our live YouTube member Q&A will be on Monday, June 17th at 5:45 p.m. Eastern Time, with highlights of the 5-year tips and 20-year T-bond auctions. And our live Bond Masters course session will be on Monday, June 24th at 5:45 p.m. Eastern Time, with highlights of the 2-year, 5-year, and 7-year T-note auctions. The replays will be available afterwards, as usual, in the respective member and course areas. Check out the links below this video for more details on our bond courses and YouTube Super Saver membership. All right, member Super Savers and bond course fans, good luck to everyone who's planning on buying at the upcoming week's auction. And see you again very soon with more brand new wealth building content for your financial journey.